welcome everybody. Let's talk real estate, your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul. And good morning to all of our viewers and listeners out there. Thanks for tuning in, listening in again. It's Tuesday, and we're going to talk some more real estate. I am Barry Saywitz, president of the Saywitz Company and managing partner of Barry Saywitz Properties. And if it's one thing that I've learned in my 30-plus years of doing this, it's to look at both sides of the equation and gather all the information and make an informed decision about whatever it is that you're doing. And so hopefully today we're going to shed some light on an important subject. I'm excited about today's show. It is a necessity of life, sort of like taxes. Our topic for today is commercial real estate insurance and how that plays into the rest of the market. Before we get going, I want to do a shout out to all of the students out there who are getting ready or are about to or have just gone back to school. It is that time of year, and while it is very hot all around the country, students are going back. Get your backpack, get your pens and pencils, and get it going, and good luck to everybody out there for another school year. So with that said, I want to welcome our guest, Jerry Conrey, principal of Conrey Insurance Brokerage Services and Risk Management, California. Jerry, welcome to the show.
Thank you, Barry. Appreciate you having me.
Yeah, so you are a longtime resident of Orange County and a longtime expert in insurance services across the board, and your company does a wide variety of insurance and risk management. And so I figured no one better to come in and talk about the insurance piece of the puzzle as it relates to commercial real estate than you. So I appreciate you coming and sharing your thoughts with us.
I appreciate that. Yeah, it's been 34 years that I've been in the business, and I've lived here in the county for almost 40. So it's exciting to bring, the place that I love, the skill set that I have and learned and have fallen in love with, and kind of an insurance geek and a risk management geek, which is strange. But I think that every business owner out there and every property owner out there, if they had the insight of a risk manager, as they look at things, as they plan things, as they do things, they might just avoid many things that they want to avoid.
Yeah, and there's many pitfalls in life, and unfortunately, California here in particular is a more litigious society than in most places around the country. And you have, as a property owner, higher value of assets that you need to protect at the end of the day. And so while there are many pieces to the insurance world as it relates not only to real estate or your business or running and operating properties, I guess let's start with, we could talk all day about insurance, I'm certain of it, but I want to start with the property insurance. For those folks out there who are not familiar with it, when you buy a piece of property, whether it's your home or whether it's an office building or an industrial building or apartment building, not only do you have to pay taxes, but it is a certainty that you need to get insurance. And if a lender is going to give you a loan on a property, they're going to require you to have insurance on the property, right? And so I guess, Jerry, talk about, since you're the expert, what type of insurance is a requirement? Because there are many different pieces and layers of insurance that someone would get. And I guess let's start with my favorite, which is you're buying an apartment building. What do you need to get in the way of insurance?
So if you're buying a typical apartment building and you're using financing to acquire it, whoever it is that's supplying that financing is going to look for their collateral to be properly protected. And the typical bank requirements are that the insurance be to full replacement value on the structure, as well as carrying a certain limit of general liability, so that if a incident was to arise, it wouldn't necessarily knock the business out of business, and have its ability to continue to make its mortgage payments and to thrive beyond the loss. And so, what is it that's typically required? Property liability. Sometimes they'll look for added coverage like flood requirements, flood insurance, sometimes earthquake, depending on what the location is and what they understand about the risk associated with its location. And then there are the insurances that you should carry even though it's not required. And that is to, protect you as the owner of an entity against losses that aren't bodily injury and property damage. So when sued for any other purpose, for an economic loss or something like that, a contractual obligation, there's insurances for that too, but that is not typically covered on the standard commercial package.
And so there's layers. I mean, there's the base, and for the layman out there, you have property insurance. So if there's a fire or a flood or a roof leak or water leak or any of those things, that would cover pieces, hopefully all of whatever you incur. And then the other side of it is the liability. So somebody slips on your walkway and falls down and breaks their knee, and they come looking for you to pay as the property owner, then that would cover that as well.
Yeah, for liability to respond, there has to be some kind of allegation of negligence on your part. Oftentimes we see lawsuits that are defended by an insurer, but frankly, there's really no negligence whatsoever. And the challenge with that is that you have to defend yourself anyways. You still have to go to court. You still have to have an attorney. You still have to put up a defense, and that could be very, very expensive. And so insurers will react and respond to an allegation, whether proven or not, and that's what you're getting.
Yeah, no, I know that all too well firsthand. Well, that's a whole nother show. And so in terms of the insurance, the lender, if you have a loan, the lender is going to require some type of insurance, and then typically they would really set the limits of what they're looking for to comply with the loan. And isn't it true that part of that is based on what risk they see? Part of that is the loan they're going to make, and then part of that would be the replacement cost or the value of the property. Isn't it a combination of all those things?
It is, but let me just say this. If somebody draws a line in the sand and says you must minimally have this amount of cover, doesn't mean that that's the amount of cover you need.
Yeah. It's
just the minimum that you can bring to them that would be acceptable to get the loan approved or to maintain the codicils of the loan. The real question that needs to be asked is what is it going to take to properly rebuild your building?
Right. If it burns down or falls down or is an earthquake or whatever the case is, how are you going to rebuild it?
Right, because if a bank is only lending 70% of the value, for instance, okay, and you've got 30% in it, well, their requirements are only going to be for what they've collateralized. That's 70%.
Right. They just want to protect their interest.
Only theirs. Right. So it's really important for all you unit owners out there, everybody who is in this business, looking to earn passive income through lesser's risk exposures, whether it's industrial, retail, habitational, always consider what it's going to take to replace that building.
And don't the insurance companies have a formula that they sort of work off of what they think is reasonable to be able to rebuild, whether that's on a per square foot basis or per unit or however that goes?
What they have is data.
Yeah.
Okay. And they are really, really good at analyzing data. And so every time a claim is paid, they understand every bit of the circumstance of that claim. They understand how big the risk was, what its construction was, what its geographic location was, and then they know what it costs to replace, right? So if they came in with a water loss, you might see this thing cost $100,000, right? Well, the question is if that only affected 4% of the building, then you should have 25 times that coverage on the building to be properly insured. But yet they're seeing buildings insured at $800,000 or $1.2 million. Yet this small little loss that only involved 4% of the property was $100,000. So how does that correlate?
Right.
So there's the company called Marshall & Swift, which has been gathering this data after every single claim is paid, and it's 100% dynamic. So every time a claim is paid through any of the insurers that participate and subscribe to their services, that data is going in and it's being added to the algorithm so that somebody like me or a claims adjuster can go in and they can put in the circumstances of either the risk itself. In my case, it's a 40,000 square foot, 100 unit storage facility.
Yeah.
Okay, what's it going to cost to replace? Well, it's made of cinder block and metal. It's sprinklered. It's in this particular zip code, and the data comes back at me pretty quickly. Yeah, and it gives me an opportunity to evolve it. Let's face it. each one of us decorate our homes differently. Some of us had wood paneling. Some of us just paint the wall. Some of us do built-in casework, and all of those customizations are capable of being put into the system properly to get a good value.
Got it. And so, in today's environment, with inflation and the cost of goods and materials going up exponentially and constantly, it's sort of a moving target, at least in today's environment. I would think that as they enter this data going forward and you see a higher cost of claims, a higher cost of replacement per square foot, that has to affect what happens to the premiums going forward. Is that a direct correlation?
It is. You know, you can't go into the grocery store without realizing what inflation has done, right? You can't go to the gas pump without realizing what's happened with inflation. Hyperinflation is here, and some of the most vulnerable out there are not those that are worried about putting food on the table. Okay, most of the folks that would be listening to this broadcast are probably not worried about that. What they should be worried about is their asset. Their asset that might have cost them $280 a square foot to build, and they think that, you know, they're adequately covered. Well, I will tell you that as of June, those things that in January cost $1, in June cost $1.15. And by the end of this year, will probably cost somewhere in the neighborhood of $1.20.
Yeah, and it really varies depending upon what you're looking at, because to build a fence, the cost of wood is up 100%,
right?
Not 15 or 20%.
Right.
And so while other things are up smaller pieces, there's no question. And then you have this supply chain issue where some of the stuff you can't even get it. So if you did have a fire or a flood and you need to rebuild, it's just going to take longer, which means you have more downtime, which means your claim is potentially bigger.
So the advice that I would give to policyholders out there is to ask hard questions now. Don't wait. Don't be a victim of a loss and then realize that you should have taken some action. Pick up the phone and call your insurance broker and ask them whether or not the risk is properly and adequately based on insurance. Have them show you. Ask them for a replacement valuation estimator. Look at the data that's in there. It's going to have things like square footage. It's going to have construction, year built, location. Those things should be pretty black and white. The things you need to be looking at are things like, well, how tall are the ceilings? At what point is the ceiling? Is it a 9-foot ceiling or is it a 19-foot ceiling? That's a huge difference in what it's going to take to replace that, footprint that's there.
Well, also, if you have an older building that may not be up to current code, if there was a loss, if you had a problem, you have to build it to current code. So things like when you start talking about office buildings or industrial buildings with sprinkler systems and lighting and handicap accessibility.
Or maybe they didn't have those things, but now they're required to.
Yes.
Right.
Yes.
So there is a coverage that every building owner should have on their policy. And it's really, really important that you not just accept the amount of cover that's automatic. So insurers are really clever. Okay. And one of the clever things that they do is they will put an endorsement on a policy with a small limit of cover. And they do that because no one ever complains about a policy getting to a limit and then it's done. Okay, I accepted that limit. I should have had a bigger limit. And so you just accept it. But when they have a circumstance in which a policyholder maybe challenges a claims decision, what exposes them, if there isn't a special limit, is the entire policy limit, right? The total value. And so the particular coverage that you're talking about is building code upgrade,
right?
Okay, and typically it's done as a percentage or an actual dollar limit, okay. And what you should just be considering is that if you have any building built prior to 1977 in California, you should be looking at about 30% of the building value being added.
As that additional coverage,
right?
Because you're going to have so much code upgrade.
It's huge.
Because the older the building, the more you got to deal with.
Right.
Isn't it true that the older the building, when you get into 50s construction or even older than that or early 60s construction, a building now that is more than 50 years old, because we're in 2022,
right?
That insurance companies either will pass on insuring it or will require other levels of coverage at a minimum, because they know if there's a loss, you're going to have that much more to deal with.
Well, here in Southern California, there's a lot of buildings that were built prior to 1977, and so there's too much market that the marketplace obviously would prefer to have all these newer, more modern buildings because they know what they've got. But the reality is that there's a lot of property owners out there that realize that the bones of older buildings are actually better built than what is built today. It may not have all the modern amenities, but its footprint and its foundation is usually more significant than it is today. And you have to be mindful of that, because if we don't construct that way today, then the construction replacement cost isn't including, to give you an example, the shear walls, okay, the use of I-beams versus using wood beams, little things, true 2x4s, because you're in a phenomenally built wood structure that has exposed wood and it's part of the decoration. And so it was built in the 40s or 50s and it has tongue and groove, true 2x4 redwood. Well, you're not going to even find that. That would have to be specially milled for you. And the milling cost on that might be, 8, 10x of what a normal 2x4, which isn't even 2x4 anymore. And so that's part of the problem, is that if you have a partial loss, you can't even get the material you're looking for to match without doing this extraordinary thing to accomplish it. And you're looking for your insurer to replace and restore you to where you were prior to loss, which is what we promise. But you have to have the proper protection to get there. And don't assume that you don't. There's a reason why every insurance policy is 37, 40 pages long. Okay. Why?
They don't want you to read it.
Well, I don't really believe that. Okay. I think that I can tell you that I have seen the evolution of policies over the last 100 years, and it used to be the policies were 2 or 3 pages long. And then there were these things called lawyers. Okay. And people would go to court and presuppose or try to recharacterize what was intended at the time of a loss, right? They'll pivot on a word or a phrase, and they'll claim that ambiguity is in the best benefit of the policyholder. And at the time and at that moment, it helps one. But what's the reaction from the carrier? Well, the reaction from the carrier in the industry is, all right, we're going to make it clear from this point forward what we intend to cover and not. And now the language doubles and triples and quadruples. And what's on page 37 is pretty important. So I'm not suggesting that everybody needs to just stop right now and read their entire contract, although I will tell you, if you did, it would open your eyes, and you'd suddenly start to realize that insurers are not bad guys. They're only doing what they said they will. The problem is the assumptions being made by folks that their policy does certain things that they've never really tested, qualified, asked a question to clarify, to get clarity, and then they find out when.
Yeah. And so the other side of it is people look at the cheapest policy and don't really compare apples to apples against what a different policy that might be more money might get them. They're just singularly focused on, I just want the cheapest insurance I can get.
Well,
which
you know
is
what?
also a mistake.
It is. It truly is. And I feel for folks who are suffering from losses today that are learning what their policies didn't have.
Yeah.
There's nothing less expensive than a proper insurance policy with all the bells and whistles and all the proper pretext. When you look at the value and you compare it and you measure that value, the cost of that insurance is actually less than the cost of the cheap plan.
Of course.
It always,
same thing with deductible, right? I mean, you can get a policy with a higher deductible that will cost less, and then all you need is one claim to figure out whether it's a win or a loss over time.
Barry, you're absolutely right. In fact, I will tell you, you want to control your costs, then manage first dollar expense, right? I'll take the first $5,000 or the first $10,000 or the first $25,000 of a loss, okay? Your deductible does not have to be $500 or $1,000. It could be $5,000, $10,000,
right.
$25,000. That is way better than to underinsure the building by $1 million,
or get junky insurance that won't cover you if you have a loss.
Or go out and get something that's just a piece of paper that says insurance and that somebody quickly looks at and checks a box. There are a lot of people out there that are box checkers.
Oh yeah.
Okay. And the reality is that insurance works because the many pay for the loss of a few. Okay. That's how it works. And when everybody gets together and puts their money into a pot, and we all agree on under what circumstances that pot can pay out to be used for somebody's calamitous circumstance, then you as a policyholder, you want that insurer to follow the rules, because you want to make sure that that pot has what you need in it when time comes for your legitimate loss, right?
For sure.
So, I mean, bottom line is that, and I don't want to geek everybody out, but what I am hoping that people take away from today's conversation is that hyperinflation is very real, and it affects you in two ways that you need to measure. The first way is on the replacement cost of things. Now, we're talking building right now, but what if you have a bunch of machinery? What if you've got processes under that roof? What if you are a restaurant with an entire stainless steel kitchen
right?
and all the appliances? Today, the appliance costs $25,000. Let's say, that's the number, okay? And maybe the cost was $23,000 this time last year, so not a big deal, right? But you go in line and you wait.
Right, and then you're
weeks and weeks and weeks and weeks and weeks for that $25,000 part to get here, or you pay $45,000 and you get jumped the line,
right?
Because that's what supply and demand does. So hyperinflation is something that everybody needs to consider. They need to be asking questions about how long it will take to get the key bits of whatever circumstance they've got, whether it's let's stay with the restaurants, an oven, for instance, or some other piece of equipment that they use every day, a sous vide machine. I don't know. Let's pick the circumstance.
Yeah.
The bottom line is that you need to take the.
I think that's my mother calling to say.
Yeah.
For those out there, it's actually. It's Jerry's wife.
I put it on.
He's got to stop at the store and get groceries.
I put it on Do Not, and I guess I probably was already on Do Not and put it on instead of off.
It's probably one of our viewers with a question. So I do want to shift gears because we only have a couple of minutes left. Time flies quickly when you're chatting away. But you're talking about restaurants. You talk about office buildings or industrial buildings. Let's shift the hat for a second to the tenant, and pretend that you're the tenant in one of these buildings and you don't own it and you just rent it. So in the case of a restaurant, in the case of an industrial building where you have a triple net lease, where the landlord is required to get insurance always, but then the cost of that insurance is passed on to the tenant, and the tenant is really directly paying for the cost of the insurance on the building. But then the tenant has to go get a separate policy for its own business, for its own equipment, for its own operations and people. So you're really talking about two policies at a minimum. And the cost of the insurance on the building itself, the tenant is not in control of. The landlord says, here's the policy I'm going to get, and then the cost of it gets passed on to you, right? Which in today's world, again with inflation, again with rising costs of insurance as a result of it, now as a tenant, your rent is effectively raised, and you didn't have any control over it, and it didn't do anything for your bottom line.
Yeah, and let me just warn those businesses that are under that exact scenario that you just described, because the landlord's insurance is for the warm shell of that space.
Yeah, it's not for your stuff.
It's not for the stuff you rely on. For instance, if you are you're an escrow office, right? And your space is 4,000 square feet, and you've got 12 people that work there, and you've created 12 workspaces, a conference room, a couple interior bathrooms, a small kitchenette, and a lobby area, right? Okay, that's typically what you'd find within that 4,000 square foot space. Well, the landlord's policy is going to return it to an open 4,000 square foot space.
Right.
Your policy is the one that needs to restore all the interior walls, the kitchenette, the lobby, the built-in reception area, all those improvements that were made, whether you made them personally or whether they were made by a prior tenant, doesn't matter. It doesn't matter. You read your lease, and it will tell you that the landlord is responsible for the building and the systems that are common. The common systems.
So air conditioning, mechanical,
electrical, life safety.
But not all the fancy. If you had a fish tank in your lobby that you had built, that's not covered. If you had really nice bookcases in your conference room, not covered.
So I go in and I look at these risks all the time, and they've thought about their desks, their chairs, their inventory, their the artwork they've hung, the networks, the systems of phones, the computers, all the stuff that they've put in there. They think of that, right? They can even go to their balance sheet and see what they invested in those things. Right. What they don't think about are the things that were put in there by somebody else that they benefit from that won't be there at the time of the loss if the loss comes from the landlord's insurer. So what are you going to do with 5 more years on your lease and you've got nowhere to, you have no door to separate the CEO from the bathroom?
Yeah.
Okay. That's a problem.
So you need to insure for that separately on top of whatever's required under the lease. And then the other layer of it is if the landlord decides to increase his coverage because he's concerned about risk for the building, he's concerned about replacement costs, or he's concerned about liability, and he raises the liability from $2 million to $5 million, you're paying as a tenant for that increased cost. And
Oftentimes, I always recommend to every tenant that if they get a CAM expense, and that's what we're talking about here, a common area maintenance expense, of which insurance is one of them, you should always look to see what your language in your lease says. Because, for instance, your lease probably says that the landlord can pass through the cost of maybe $2 million or $3 million worth of liability. But anything above that is supposed to be the landlord's expense. But they'll pass it through to you if, because sometimes they don't even read their own document, right? They've done it so many times, they don't think about it anymore, and they just pass the expense through. And that's usually done by an accounting person that doesn't even know what the language of the contract says. But the reality is that you as a tenant are not obligated to do that. So always look at the language of the lease and make sure that what is being asked of you is compliant with what you've agreed to do.
Yeah, and we recommend to our clients just copy the insurance paragraphs and pages out of the lease, send it to your insurance guy and your risk manager, and make sure that they've taken care of it and analyzed it before you sign the thing.
Can I share one more scenario that I think is important?
We got 1 minute left
Okay.
because I know you got to run, and
Me
we're
too.
almost out of time.
Yeah.
And so,
There's a lot of condo owners out there, commercial condo owners, people who own their space, but the association insures the building, right? These folks are just like tenants in the description that I just described.
yeah.
Okay, it's really, and you probably have even nicer things built into that space. The casework, the fancy floors, fancy finishes. Be sure that you understand that when your bank goes and looks at whether or not the insurance is, meets the requirement, they're looking at the association's policy and not yours. And they're not considering all the improvements that you've made in that space. And if the building was to somehow get damaged and restored, what's going to be restored is what was there when the developer handed the space to the first new owner, and it would have just been a shell.
Right. And so you need condo content policy to cover your stuff. No different than a tenant in an apartment building needs renter's insurance, or a restaurant needs operational, business.
Yeah, they call that tenants improvements and betterments, and it can be part of contents cover, or it can actually be a separate line depending on the insurer, because sometimes they charge a lower rate for tenant improvements than they do for contents, because contents can be stolen and tenant improvements are pretty much hard to steal. Yeah.
So interesting stuff. We could go all day, but unfortunately we're out of time. Is there one thing that you would suggest with all the things going on in the world today, inflation, stock market, war, gas prices, that you suggest to people to take a look at? I mean, my take would be make sure that you have a professional like yourself that you're dealing with. Let them do the legwork and give you sound advice. But for your clients out there, is there one thing that you're advising them going forward in today's economy?
Ask qualifying questions. Make sure that you don't have to be the expert. Ask the expert. And if you don't feel like the person is responding in an effective way, if you don't feel like they're taking it as serious as they need to, understand that there's 3,000 other licensees, nearby that you could reach out to and that you can get engaged that maybe will not be as complacent as that. But do ask the right questions. It's important for you to know what you've got before you've had the loss, rather than learning after what you could have done and didn't.
Yeah, certainly. And so how do people reach you if they want to find out more information?
They can go to my website, conreyinsurance.com, or they could give me a call at 877-450-1872. Conrey Insurance Brokers. Appreciate it, Barry.
Perfect. So anyway, somebody's waving at me, and then Jerry's spell Conrey. So it's ConreyInsure.com. Right. And if you don't get that, you can go to Saywitz, SAYWITZ.com, right? So anyway, to wrap up for today, Jerry, thank you for all of the input.
It was fun.
And the advice and certainly valued information for anyone who is buying a property or thinking about it. If it's Tuesday, we're talking real estate. So for all of our viewers and listeners out there, I am Barry Saywitz, and we will be back next week with more real estate. Thanks to everybody here at OC Talk Radio, Paul, Sophia, the whole crew. We'll see you again next week. Thanks for listening and tuning in.
Thanks, Barry. It was fun BSing with you.
Yes, thank you.
Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.